Hey everyone, welcome back to another episode of Keeping You in the Know, all things real estate. I'm your host, Carey, with CMG Financial and My Mortgage Team, and I'm super excited about this episode because we're going to be talking all things credit. And we have the very talented Devin Norcross with us. He is a 13-year veteran in this field, so he is truly talented about all things credit. Super excited. He's the owner of Norcross Consulting Services. He and I go way back. It's crazy. We're aging ourselves in this industry. We've been doing this business for so long. But welcome, Devin, to the show.
Thank you very much. I'm super excited to be here. I'm born and raised in Tennessee. And while I live in Denver now, I still call Nashville home. My whole family's there, mother, grandma. I own property out in Cheatham County, and I love working with Tennessee clients.
Yes, well, we're excited that you're here because, you know, when we're talking about all things real estate and keeping everybody in the know, credit is such an important piece, especially when clients are looking for financing, because the better the credit score, the better the options, the better the interest rate. And so we're going to talk about three things, I think, today, if that works for you. Number one, what's the difference between an online credit report and a lender's credit report, and why do they differ? So that question gets brought up a lot.
Yes.
Maybe talk about ways that we can help boost our credit scores right now, whether we are a real estate agent or a consumer. You know, the higher the score, the better the interest rate. So we could have a 620, a 640, 680, or even a 720. How do we boost that up just a little bit more? So love to talk about that. And then also, if we are somebody or have a client who has some credit challenges and maybe a lower score due to this or that, what is the journey that someone goes through when trying to boost their credit report, credit score? You know, how long does that take? What are the steps that go into it? And then really, how much does it cost for somebody to help me, you know, boost that score? So excited to get started with this, Devin, here. So let's talk about the difference between the online and the lender's credit report. Can you get some insight to that?
Yeah, absolutely. And I've shot some video content, and this is probably the video that I share the most. I find it the most relevant and really the most needed, and as well as most commonly asked for. And what's happening here is people need to disassociate the credit bureaus from their credit scores. Okay. So what a credit bureau is, it's a data collection firm. The best way to think about it is a filing cabinet. Capital One's going to store a file on you. Discover's going to store a file on you. Maybe Phoenix Financial if you have medical collections. And it's just data. It's not interpreted. And they've been around a long time. Equifax opened in 1895. So there's really old firms, and they're huge. Equifax in 13 countries. And they manage over 1 billion people's individual credit history. What they are not is they are not companies that specialize in analytics. They are not statisticians. So they partner up with other companies to interpret that data. The company that kind of has the biggest hold on credit scoring models is a company called Fair Isaac Corporation, or FICO. Your clients have probably heard of their FICO. And they tend to say, I have a FICO credit score. This is my FICO score. And that's not necessarily accurate. You have lots of FICO credit scores. My last understanding was there was about 64 different FICO models. Wow. And they can be applied to any of the three credit bureaus. And in fact, there's bureaus outside of those three, like LexisNexis, which you're probably familiar with. Mm-hmm. So a FICO credit score is a credit score that interprets your credit bureau data using one of the FICO models. And in the mortgage industry, if we're going to sell loans on a secondary market and not hold them internally, the secondary market wants to have those credit scores with an approved FICO mortgage model. So we do see, we call models 5, 4, and 2. That's Beacon 5.0, Classic 04, Fair Isaac version 2. There's no reason your clients need to know that. What they do need to know is that those models vary very differently and very heavily than what most consumer sites use. So when you want to, as a consumer, check the status of your credit or see what's on your credit, you got to go most commonly to an online site. 2/3 of the American population that's adult age owns a Credit Karma account. It is what it is.
Sure,
Credit,
yeah.
Phenomenal job infiltrating the market and unfortunately misleading a lot of people on their credit scores and making your job and my job very difficult in some cases. Now, there's a company that competes with FICO called Vantage, and this company creates scoring models out there. And when we create a scoring model, it puts people on a graph and judges them against each other, and they call it a risk model. So Vantage has some algorithms called Vantage Score. And I kind of interchange the word algorithm and model, same thing. Vantage Score models can be used to interpret your credit worthiness. There's some really big differences between how Vantage allocates their points and how they penalize you for negative items. And the penalty for the negative items are where most people kind of get a big difference, especially credit repair files that I work with. And here's the three largest differences between a Vantage model and a FICO model. Vantage penalizes collections, similar to FICO, but it does not penalize collections whatsoever if the collection is paid, if it is a medical that is under $500, or if that collection is received in the last 6 months. Some of the newer FICO models like FICO 9, which we do not use in the mortgage industry, are getting to, closer to some of those principles. And the reason is the industry knows that medical debt is not an accurate indicator of loan worthiness. But right now we still penalize that like any other collection. Mm-hmm. So let's say your client has 5 medical collections or $400 each. Vantage is not going to penalize them at all, but FICO is going to interpret that like any other collection, which is to say the more recent that collection is, the more it affects your credit score. Hypothetically, your client just receives a collection. FICO is going to look at that as a very heavy negative mark. Vantage does not. Vantage says, all right, you have 6 months to realize you have a collection and pay it before it's really a risk. And that the reason is a lot of people, they don't put a lot of energy in contacting you when you have medical debt. That's the ugly truth. Sure. I have clients tell me they have collections hit their credit report with doctors they see frequently, and the accounting agency never told them about it. Hmm. And then there's the other one that can be really bad, which is paid collections. And this is where we can really see some nastiness pop up. Credit Karma advises you to pay your collections. And I'm not necessarily saying you shouldn't pay your debts, but there needs to be a well-thought approach to how you pay your debts when you're looking at raising your credit score. If Vantage, which is what the Credit Karma site is using, or Identity IQ or Credit Check Total or Score Sense, or a lot of those places, is advising you to pay your collections, but FICO was penalizing you based off the age of those collections. All right, the older your collection is, the less it weighs, and this is actually on a downward exponential scale, so you can kind of think a downward banana curve. If you take a collection from 2014 or 15, maybe even 16, the reality is it weighs very little to your credit score. All right, and if you then go and you pay that based off advice that you receive from Credit Karma, Credit Karma is no longer going to show a penalty, but FICO is going to treat that like a brand new collection. All right, so it's really important when we're talking about how and when to pay debt that we do not pay debt without an understanding. I'm going to coach your clients. We either don't pay it, we pay it at closing, and we run a supplement if we're going to do an automated underwrite, or we provide the proof of payment to the underwriter, or we're going to negotiate a pay for delete agreement, which is a great opportunity in the Tennessee, Kentucky, Central Valley area. I've got relationships with pretty much every collection agency, Fox, Phoenix, Wakefield, GLA. So if your clients have questions about how to handle collections, I'm ready for them.
Wonderful. Well, that's amazing. What you're saying to me is there is a huge difference, right? So one that is marketed so frequently online actually definitely uses a different model or has the different algorithms. And that is why we see the different credit scores. It's not because Carey Ann repulled your credit and that's why your score is different. There are 2 different models that we're looking at. It is amazing. Hopefully one day we'll all get on the same page. It'll make all of our lives a lot easier. But right now, like you said, if you're doing Vantage or the FICO, that's where the difference, lies. So talk about—
Carey, I want to jump in real quickly. I'm sorry, I should have mentioned this. So one of the resources I've been providing to clients and lenders over the last 3 or 4 years since I discovered it is the ability to check your mortgage FICO scores in a soft pull format. So let's say your client is really concerned, although they shouldn't be. Let's say the client's really concerned about letting you pull their credit, or they're wanting to just check what their FICO scores are. And keep in mind, you have mortgage FICO scores, automotive FICO scores, insurance FICO scores, and credit card FICO scores.
Right.
And then you have models like 8 and 9 that aren't even being used in either. So your score is going to vary. But you can get all of those numbers from FICO directly. So there's a site called myfico.com. It's $29 for a one-time pull or $39 for a monthly pull. This is a soft pull. So when I'm working with a client like one of yours and it's been 90 or 120 days and I'm estimating we've had 50 to 80 point gains, before the lender or someone repulls credit, I'm going to have the client sign up for my FICO. We're just going to take a little prism look and see where they're at to make sure what you pull is going to match. And whatever that site says, if you pull credit that day, those are the exact numbers you will get.
Wow, that is huge. Thank you for
Yes.
that little nugget of goodness
Yes.
there. I love that. So let's talk about, you referenced 80 points, which is huge. And I know sometimes it doesn't take 80 points to make a huge difference in your mortgage transaction, right? There's different thresholds. Usually they're in 20-point thresholds of improvements. But if you could share maybe 3 things that the average person can do, and it doesn't mean that, you know, even somebody with the 680 credit score may want to try to get over the threshold or 700 or 720, right? What could we do on the short term to boost our credit score?
Yeah, I would love to answer that. And I'm going to preface that with another topic. And that's that there's something that's happened completely out of our hands. And that's the COVID crisis. And I don't know if you want to share CMG's personal approach to this, but I know lending institutions, we could pick on Chase Bank. Chase Bank went from a 580 minimum FHA to a 700. And I'm not going to mention other ones outside of that, but a lot of people who were pre-approved 3 months ago through no fault of their own are not pre-approved right now. So right now, every point matters. And then to speak about rates, yes, what we see is about every 20 points. So there's some things that I can talk generally with my eyes closed to anyone about. And the number one thing is that the scoring models that we have to utilize, they put twice as many points into revolving accounts as they do installments. All right. You got to pay your car. They're going to take it away, but you need your car. Are you going to pay your JCPenney's bill? You know, and so the algorithm is really set up to test your responsibility with the unsecuritized debt a little more heavily. So do you have revolving credit and how do you manage it? All right. So the first thing, a lot of my Tennessee, Kentucky, Virginia clients, especially anywhere rural, especially because you got Dave Ramsey running around there on the radio all the time. But one of the things they are not big on is credit cards. And so my fight is always to get clients to establish revolving credit history to start. If you don't have a credit card and your score is very low, it's okay. There's what we call secured credit cards out there. And secured means you put a small deposit. It's usually $200, maybe $300, and that's what your credit limit is. And if you have particularly bad credit, a lot of vendors, especially local banks, Fifth Third, BB&T, they don't want to offer those secured credit cards. There's ones that don't even do credit report checks, like Open Sky. So everyone can do one. And then beyond that, how do you handle your credit cards? So here's a credit tip that I really like to talk to people about. And it's not where to keep your balance, but when to pay your card. Most people are aware of their due date, and they structure their payments a day or a few days before the due date. Well, what happens is that due date only affects when your interest is applied or calculated. Your reporting date, which is a term I know you're familiar with, but your clients might not be, is when your balance is issued to the credit bureaus. And that happens once a month. When you pull my credit today, it's not what my balance is today. It's what my balance was on my reporting date anytime in the last 30 days. So what I like to do is I like to have my clients call the number on the back of their credit card and find out their reporting date. And I did a little exercise about 8 or 9 years ago when I started really advising this. And I started asking a lot of clients to do this and report back to me what their due date and what their reporting date was. And what I found in that time was that there's an overwhelmingly large amount of my clients had the reporting date about 7 days before the due date. And I started kind of asking myself, why is that? And if you think about it, if you took a calendar line and drew it in a linear line, day 1 through 30, all right, and your reporting date is on the 15th and your due date's on the 22nd, when are most people paying their cards? They're paying their cards, you scatter plot that a few days before their due date. But that balance is being reported right before that. And unfortunately, there's kind of a sinister reason for this. All right, if I report your balance statistically at its highest point in the month, I'm making it appear as you have high utilization frequently. All right. These clients, these especially Capital One, First Premier, they do soft pulls on your credit all the time. And these are all variable APRs. So if I can impact your interest rate from 17.9 to 21.9, but I do that on 100 million files, it's a large profit margin. So it's really important to know your debt utilization, your revolving accounts is calculated 1 day a month. It's on your reporting date. So if your card's maxed out 29 days a month, but it's paid down the day before your reporting date, none the wiser. Not the best financial advice always. We do want to keep a balance below 30% if we can. I don't encourage maxing out credit cards, but pre-purchase of a mortgage or an auto or something large, it's really important to start scrutinizing dates very closely.
Awesome. So double check those dates. That's huge. We just flip our credit card over, call, double check that, keep it under 30%. That's great information. And just kind of circle back with the COVID. So blessed to be with CMG Financial because we never changed our guidelines. So we allow clients down to a 580 credit score.
Wow.
Yes, no, 580 on our FHA and our VA loans. So, but we do want to talk about the credit because again, the higher the score, the better the options and the better the interest rate. But for us, we still help all of our clients, you know, at least down to a 580 and options lower too. So that's something great about CMG. So let's talk about the client. And again, I help many families and I'm really blessed to offer my services to all that somebody may have had some challenges in their past, right? So maybe they do have due to all of the things that have recently occurred or in the past, a 550 credit score or a 530 score, let's just say, right? And so working with your consulting firm and, you know, your repair company, talk me through that journey that one would take to work on boosting their credit. How costly is it for me to really work on my credit? I get that question a lot. And the time frame it takes to work on getting those 80 points that you spoke of, things like that. So why don't you share a little bit more about, you know, that journey? Sure.
Well, it's really important that everyone understands that it starts with a conversation. It starts with a free conversation. You know, I want to talk to you about your credit. You know, how you got there a lot of times isn't as important on how we move forward. So we should really focus on that topic more than how we got to where we are. I want to hear the explanation of anything that goes on, but a free consultation over the credit report is very important. I've got plenty of soft pull sites I can utilize if your clients don't have a credit report. With your client's permission, a lot of times we can utilize your reports. What we're going to identify on that report is going to really dictate where that conversation goes. Sometimes it's more of a debt settlement. You know, credit card debt, I typically settle from 30 to 70% of what you owe. The older it is, the less they'll settle for typically. Tennessee has a 6-year statute of limitations on debt collection. So typically when, you know, and to kind of clarify what I mean by that, the Federal Trade Commission says you can report something to your credit report for 7 years as of the date of last activity. So if there's no activity, it's 7 years. Let's say it's 6 years, they get you on the phone and you make a $5 payment plan. They don't care about the $5. They're going to eat that in interest. It's to re-update that timeline. All right. So you never make payment plans unless you know exactly what you're doing. The state has said, okay, we will allow 6 years for you to jam up our civil litigation team and apply judgment to someone. Okay. All right. So if they don't take you to court within a 6-year time frame, they can't. So if you have a very large ticket item and it's 6 years and 3 months old, you know, sometimes I'm having a conversation of, do we want to address this or do we want to wait for it to fall off? And there are situations where that is the better move. Okay. But unfortunately, if you're, you know, between 4.5 and 6 years old, you're at a very high risk of something ending up in an attorney's office. All right. Because once they get that judgment, they have 10 years to collect on you through either a wage garnishment, a lien against their property, or unfortunately, sometimes bank levies where they come in and they actually take money out of your account. So we want to figure out very quickly, what are your goals? How long do you have to make it? And what can you put forward towards that? So does your lease end in 90 days and you need 60 points? Is it that you only need 20 points, but there's a $24,000 repossession? Repossessions settle for around 10 to 30% of what you owe. 10% of what you owe on repossession is not uncommon. A lot of times they have really baloney fees from the repossession and the auction and everything else. A lot of times they don't even reduce the balance by what they received at auction. So repossessions are kind of a different animal. And then what's going to help your credit to pay and what's going to hurt your credit to pay? The worst thing I hear from a client is, I'm already working on my own credit. And what that typically tells me is that they've pulled money out of their 401k or they borrowed from a family member and they paid off all their debts. And as we talked about, that DLA, or that date of last activity, is so important. It's what FICO judges these debts off of. It's age, not balances. Paid collections can hurt you more than unpaid collections. So an uneducated approach can really kick the can down the road a long time. So if you're thinking about some kind of credit repair or some kind of credit improvement, talk to Carey Ann, talk to me, talk to someone before you go and you start paying these accounts, because it can really be a kiss of death for a short-term mortgage need.
Yeah, that's wow, amazing. Now, the cost to utilize your services, is it,
Yeah,
one
so
lump
if we're not
sum?
talking debt settlement, if we're talking credit repair, which we're going to try to get items removed, and that can be through deletion letter negotiations with creditors, that can be through Fair Credit Reporting Act investigations with the credit bureaus. I charge everyone the same across the country. I charge a $99 enrollment fee. And what I have there is a one-time lifetime membership fee. So if it's Christmas time and you want to drop the services for a few months, or 3 years down the road through an unemployment stretch or a divorce or injury, you do have other credit challenges, that fee's waived if you come back on board. My monthly fee right now is $109, and I just raised it $10 a month. But what I did is I incorporated a really great credit monitoring service that my team can utilize and your clients, and we can update credit up to 3 times a month. I was kind of chasing around. It was herding cats and dogs trying to get all the result letters from my clients. So I kind of had to take that responsibility off their plate and add in a monitoring service.
Sure.
And
That
before,
only improves the speed, right, of getting the
yeah.
score up faster. Sure. Yeah.
Yeah. But before we, move on, I want to, come back to our just really quickly to our previous topic. If your clients have revolving utilization, there's a couple ways that we like to reduce that. I'm not big on opening accounts, but if you're not trying to purchase for some time, there's some great zero balance transfer, zero interest cards, 18 to 24 months, Chase Slate, Barclay Ring Card come to mind. There's some good opportunity there to move debt to a zero interest. You can always securitize unsecured debt to any kind of mortgage property. So I know that you do a lot of cash out refis. I know you do a lot of home equity lines. That's really, I have had some of the most horrible stories I can tell you in the last 2 weeks about clients who got with debt consolidation or settlement companies. Especially attorneys. Carey Ann, I could send you a file where the client agreed to pay $13,000 in attorney fees to be consulted, and she thought that's what she was settling. I've got the screenshot.
Right.
The other thing that we can look at doing to increase credit on a short term is credit limit increases. All right, so if you have a $300 credit card and it's maxed out, and you don't have the funds to pay that down, on the very short term, you could have that credit or ask to have that credit increased to a $600 limit. Now your utilization is at 50%. So credit utilization is something we use very much because of it's not coming to mind right now, the term is on the bottom of every form. I'll think of it in a second, but everyone needs to have an equal playing field, all right? Age, race, ethnicity, and income can't affect access to credit lines. The ECOA, Equal Credit Opportunity Act. Because of that, every revolving account you have weighs the same, all right? And it splits up a 30% category of your FICO score. So let's say you have 3 credit cards. One's $300, one's $1,000, one's $3,000. They're each worth 10% of your score. And let's say across the board, they're all maxed out. Because they are equal credit lines, paying down your $300 card is going to give you just as many points as paying down your $3,000 card. So from a credit standpoint, not a financial standpoint, from a credit score standpoint, we always prioritize our dollars towards these smaller credit limit cards first. We're going to get more bang for our buck to the credit score. Now, there are going to be interest rates that impact that. And so this is really a short-term play, not a long-term play. You do want to stick to highest interest rate debt from a long-term play. But when we're getting ready to prepare someone from a new credit pull through you for hopefully a pre-approval, sometimes dollars aren't going to the highest interest rate card first. They're going to the card that's going to have the best impact to their credit score.
Sure. Wow. You have shared, Devin, so much great information. For the folks that are listening out there, whether you're a real estate agent or a consumer, if you are looking to get some guidance on how to improve your credit, or if you have a lower score and want some assistance on increasing that, definitely reach out to us because we'd be honored to help you. One of the programs that I offer that maybe some of you don't know is whatever you invest in boosting your credit score. So Devin shared a very cost-efficient way of working hard to get the score improved. we would then honor and match that back towards your closing cost up to $750. So hopefully that $750 that you would invest, maybe it'll be less, or a little bit more to really get that score to where you need it to be. We would then credit all of that back to you towards your closing cost on your next purchase. So Devin, thank you so much for being here. I know we love COVID, that we've learned Zoom, and I know you're on a family trip and you took the time to visit with us today. So thank you so much for all of your wisdom and your insight and expertise on this topic. We will see everybody next week for another episode of Keeping You in the Know, all things real estate.